Hello, this is Manesh Patel from ichimokutrade.com. Today is September 24, 2015, and we're going to actually go for another great trade review today for you. In fact, what we're going to do is we're going to actually show you how you can make 300% or higher on your option trades. A lot of people talk about you could only make 10%, 15%. Some people are happy with doing 5% and so forth using vertical spreads or iron condors and stuff like that. However, that's not great at all, believe it or not. If you're sitting there getting 10% on an option trade, that means you got an inverted reward risk, and that's not good at all. And the reason why is that without a 3-to-1 reward risk ratio, which is a 300% gain compared to your risk, you're never going to survive in this industry at all. Today we're going to show you what people are not telling you and so forth. Okay, so let's begin. Before we begin, we got a normal disclaimer here to state this is for education use only. We're not soliciting you to buy or sell any particular instrument. If you do so, you're doing that at your own risk. All information is owned by EII Capital Group, cannot be copied or distributed without our written permission. We are broker neutral, so we use variations of Thinkorswim, TradeStation, and eSignal. And as normal, here are my contact details here. So if you have any questions, you can email us or contact us. Okay, so let's get to the trade review. One of the countries that we've been watching for a long time has been Brazil. We've been going in and out of trades here. So I want to show you the last trade that we took for the Brazil market. So let's look here, and I want to show you the monthly view with Ichimoku here. And you could see with a monthly view here with Ichimoku that this is slowly trickling down here. And you could see here that price kind of was retesting this support right here, and on this week right there it kind of started going down. And that's what we're looking for, is a nice little trend, and then we're looking for a trend continuation, which is exactly what we're getting here. Okay, if you look at this from the weekly time frame, this is what it looks like on the weekly time frame here. And then if you look at it from a daily perspective, this is exactly when we entered here. So the daily, weekly, monthly, and all the lower time frames, believe it or not, were trending already. And what happened was, in this little consolidation period here, we actually had a multiple time frame resistance set up on the swing trading and day trading time frames. So what we did was we went from a lower time frame, we used a risk from a lower time frame, and to sit there and get a reward for a long-term trade here. Okay, so we were looking for this to be long-term, but we wanted to get in on the lower time frame to keep our risk low. So if you look at the option trade here, and this is hard to see, so let me move this down here. We ended up doing a vertical spread. Now this is a debit spread, not a credit spread. Same thing. The only difference between a debit spread and credit spread is that on credit you got the money that you're going to get, and then your goal is to keep it. With a debit, they deduct it and then you have to earn it. Same type of scenario, believe it or not. Okay, what happened was, when we looked at this was the ETF for Brazil, EWZ. Okay, when we looked at the option chain and everything, we looked at volatility. Volatility was high. As a result, we had to sit there and go to a vertical spread. So we did a debit vertical spread in here, and if you look at it, the red line here represents the risk graph for it. And remember, look over here at this red, and you can see this is January 16, 2016 options, and we're betting on this thing going down. And if you look at it here, we risk a total of $36 for 3 contracts, and our potential upside is $364. That's way over a 3-to-1 reward risk ratio. Okay, now as this thing keeps on going down, we have a potential of making not the 3-to-1 reward risk ratio very fast compared to sitting there waiting all the way up here to January. So if this stock, this ETF, goes down faster than most people predicted, then what's going to happen is we're going to get to our 3-to-1 reward risk ratio. And that's exactly what has happened. The stock has gone down, the ETF has gone down. So if you look at the white line here, that represents our P&L today. And you could see here, if you look over here, we risked $36, and right now we actually have a profit of close to $100. Okay, so that's a 3-to-1 already today. Okay, now you got a couple of options. You could close out this trade for 3-to-1, and at that point you could look for another pullback, or you could sit there, take off some of your positions at 3-to-1, or and then let the rest ride, or you could let this ride with a very tight stop based on the technical chart. And if you let it ride, here you have a potential of taking that $100 profit, and sitting there the upside would be $264. Okay, so there's various options here you could engage in, and that all depends on your personality that you have and what you like to do from the money management side. As far as we're concerned here, we still don't see a weakness on the charts, so we're going to sit there and let this thing ride, keep on going down. We're going to keep our stops very tight where we're managing off a swing trading time frame, and we're going to keep on sitting there watching this chart go down. Okay, and remember, this trade was done by looking for something that's out of the money. A lot of people tell you can't make money out of the money. You can. Okay, if you know how to read the charts, the Ichimoku charts and so forth, you could sit there and project where price is going to be at a certain time, and you could actually make really good money with a very low risk doing out of the money option plays. And this is a perfect example of one where you do out of the money. And you could see here that the stock was actually up here about $23, $24, and we did this vertical spread, which is $20 and below. So we did this way out of the money, a couple of strikes out of the money, and it was also a January 2016 option here, so it gave us a lot of time. So what we're doing is we're actually playing the delta, the price movement going down, and we actually captured on it very well. Okay, so this is a perfect example how you could sit there and get a 3-to-1 or a 300% return or higher. It all has to start, believe it, on learning how to read the charts. Once you understand how to read the charts, all you're doing is you're going to look at options to enter that position. You're not going to do it like other people are doing it, where basically you're learning all these sophisticated option strategies and so forth, and you're assuming that the stock's going to go sideways. We don't do that at all. Everything has to start with the charts for us, and we're just using options to basically enter the position. Okay? If you like what you hear and you want to know more, you could email us or give us a call at any of this information down here. Have a good day.